Hi, everyone. This is Jason Miracle of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's been covering gold and silver markets for over a decade as Turd Ferguson and Craig Hemke at the TF Metals Report. Thank you for joining me again.
Jason, it's always good to visit with you. Yeah, the name Turd Ferguson is something I got stuck with back at Zero Hedge 13 or 14 years ago. Even my mother, rest her soul, used to call me Turd after that. But now everybody just calls me Craig. It's been a long, strange journey.
So we're recording this interview on Tuesday, December 5th, 2023. There's been a roller coaster in the paper gold prices the last couple of days alone. The dollar index is rising again. It's been in a range. They knocked it back down temporarily, or DC's managing it, should I say, but it's rallied a little bit to 103.95. The roller coaster in gold futures contracts on Sunday night, what we got up to over 2140. I don't know if an investment bank was caught short or a margin call or something like that, but we've just had an enormous swing in the last couple of days. We've gone from 2140, and you've been talking about this for a week, that this was the first monthly close in gold prices over 2000, I think, in history in US dollar gold price. And now we're back down to 2018. It's just a crazy, wild roller coaster swing in the paper futures contracts.
Yeah, it sure is. And what interesting timing. We've seen these kind of counterintuitive slams before. Anybody that's followed the metals for any length of time saw Sunday night and went, wait a second, I'm getting deja vu here. But yeah, to go back to last week, the spot gold price had never had a monthly close north of $2,000 ever. And that happened on Thursday. And then spot and futures all went out at the highest weekly and daily close of all time back on Friday. It was so rich, Jason, that even Barron's Magazine on Saturday had to write up a story about how great gold was and how people should be buying the mining stocks.
That's kind of a curse.
Yeah. Well, all right. So here's the interesting thing about Sunday. We did not gap open $60 higher Sunday. Okay. It wasn't like, oh, everybody was all excited all weekend long waiting to buy gold futures. No. First 15 or 16 minutes were sideways. Opened up a couple dollars, then came back down. Okay, so everything, and the dollar index wasn't moving. Bond market was unchanged. And then all of a sudden, in 12 minutes, the price of gold, at least in the futures market, shot up by almost $60. Okay, so what's going on there? Well, an informed speculation on my part after 13 years, but to me, the banks were painting the chart. And doing so to crush sentiment and momentum. Because again, at the close on Friday, every single short, naked or otherwise, that had ever been created in the future of mankind was underwater, okay, and at a loss. And the bullion banks had to regain control of the market by killing momentum and killing sentiment, at least in the short term. How do you do that? You allow a big, huge, massive, nasty reversal to be painted on the chart. Price surge, like I said, in about 15 minutes. To me, that's pretty easy to do. Sunday night, lowest volume time of the week. You just simply remove your offers. And at all-time highs, you're going to find all sorts of air pockets if you stick some bids in there, or if there are any bids at all. And up you go, fast, almost like a short squeeze, or when you fall through and you hit a bunch of sell stops when you lose support. And you get this huge spike. And then all of a sudden, after that, price gradually comes back down, goes down through the London session. And then at the COMEX open, it's straight down again. You get to the 10 o'clock Eastern London PM fix, it's straight down again. We now know all of the open interest that rushed in on Friday was flushed right back out. Then all the speculator hot money was flushed back out on Monday. And again, it's just another effort by the banks to regain control of the market. I'm sorry for the long answer, Jason, but we've seen it countless times before. I think most famously back in 2011, after a summer of debt downgrades by the S&P of the U.S., fiat currency weakness, a dollar and the euro weak and looking terrible in August and into September of 2011. The only two safe havens at that time were the Swiss franc and gold. And on the morning of September 6, 2011, the Swiss National Bank announced they were pegging the franc to the euro, leaving gold as the last man standing as a safe haven. And guess what happened? Gold immediately fell. I give it 15, 20 minutes, and then it immediately fell. From top to bottom, 24 hours later, price fell $120. From top to bottom, this last Sunday, price fell $120. I'll give you one more. How about the night when Trump was elected, Jason? You remember that night?
Wasn't that around Brexit too?
Well, and Brexit was another similar event. But when Trump was elected, remember, he wasn't supposed to be elected. It was supposed to be Hillary, 97% chance of winning or whatever 538 said that day. Then as the night went on, Tuesday, November the 7th, November the 8th, whatever it was, 2016, all of a sudden, Trump's going to be elected. Gold is soaring until the London Open. And then gold plunged. And we got to the COMEX Open and it plunged again. And from peak to trough a couple days later, guess how far it fell?
I think you were talking about 120 is a magic number. So the algorithms like that number.
Yeah. How about that? So again, when the banks get wrong-footed, get caught on the wrong side of history, whatever, you can always count on some deliberate, overt, manipulative event to shake out price, shake out some spec longs, regain control and sentiment so they can kind of regroup and plan their defenses going forward. And that's exactly what you got Sunday night.
Well, I would argue that the supply-demand fundamentals are very different this time. I think back then in the time periods you were mentioning, there was still a lot net purchases of U.S. Treasuries with a lot of foreign central banks, especially outside the G7. They were buying net Treasuries. That has changed a lot, an enormous amount. In just the last 18 to 24 months, it really seems that things have changed structurally to where outside of the G7, the central banks with their foreign exchange, their trade surpluses and foreign exchange reserves, they are not recycling into treasuries.
Oh, for sure, Jason. And again, we just got the data for October, another 43 or 44 net gain of metric tons across the central banks of gold demand. It's going to be the biggest year. Last year was the biggest year since 1968, and this year is going to be even bigger than last year. You and I have spoken before about this odd gap that it seems that some have finally started to notice between real interest rates and the gold price, and how gold has tracked real interest rates. It's probably been the most close correlation that it has for decades, until about a year and a half ago, when all of a sudden real interest rates based off of nominal rates and inflation expectations began to soar and go positive, but gold has hung in there. And there are people looking at that chart going, why isn't gold like $1,200? That's where it should be based on real interest rates and that correlation. And instead it's 2,000. I would say that's because there's no gold. I mean, the banks, they have to deliver physical gold at that price. And if they drop it to 1,200, there just simply won't be any left.
Yeah, I agree. There, on the supply side, there's just not the miners. There's almost zero miners. Barrick Gold, Newmont Mining, they can't make money at 1,200. I mean, their costs are around 1,100. Yes. And then on top of that, the other thing is on a relative basis, 2,000 seems like a high number, but it hasn't kept pace with the consumer price index. So if you were going to inflation adjust, gold should be way over 2,500 on the CPI if it was tracking inflation, the government's official inflation number.
Well, that's for sure, too. And so, again, putting it all back together, there are a lot of people out there that see one day's chart and that ugly reversal candle, and now all of a sudden gold's going to 1,600 or something like that. And God, who knows? But I think that's doubtful. And I suspect that we're going to end up okay by the end of the month, recoup most of those losses. Typically, I don't know, maybe I shouldn't say typically, Jason, but over the last 6 years, gold and silver have had very strong Decembers. And here's, I guess, where I should say typically, it's a very strong seasonal time of the year. Indian demand picks up ahead of the wedding season next spring and summer. In years like this, when gold's expensive, it's also usually good for silver demand too, as people kind of swap steak for hamburger in that regard. But seasonally, like I said, the last 6 years, gold has averaged a nearly 4% gain in December.
Chinese New Year purchases too, a couple months in advance ahead of Chinese New Year.
Right. That too. So there's reasons why gold is typically pretty strong in December, but yet here now we've started the month down $30 or $40. My one concern for the month is that the market has gotten pretty aggressive over the last month. And I mean, the Fed funds futures and rate hike cuts and expectations, that kind of stuff, they've gotten pretty aggressive with where they think Fed policy is headed. Heck, Jason, just today, Tuesday, I saw something. There's now suddenly a 15% chance of a rate cut next month in January, and like a 60% likelihood in March. That might be a little aggressive, and the Fed may throw a little cold water on that when they meet next week. But nonetheless, to be sitting here at around $2,000 as the next easing cycle begins.
Well, it depends
the banks just simply
depends, Craig, if we get another Credit Suisse event.
Well, yeah. How about the concern about UBS a couple of weekends ago? That sure seemed valid too. Anyway, the moral of the story is,
what do you mean about UBS? Because there were rumors going around Twitter, but I heard they were false.
Yeah, I don't know. Again, you could certainly see where that could possibly be true. I don't know anything more than what I saw on Twitter either, but you could certainly see where after the forced marriage, where the Swiss National Bank, basically gave UBS an ultimatum. They had to absorb Credit Suisse. You could see where that would maybe create some balance sheet issues in the intermediate term for them.
Well,
we'll see
Craig, we've discussed this. Didn't you see that the Swiss government and the Swiss central bank are guaranteeing those interest rate swaps? So UBS isn't paying the entire bill. It's the Swiss taxpayer and the currency that's going to take the bill, the Swiss franc.
Again, to the extent that, that keeps the plate spinning. But anyway, we don't have, that UBS Credit Suisse notwithstanding, they've got enough other banks that we should have to, be concerned about. And again, all of this, we stand on the precipice of another election year, which is going to be crazy, not only for the markets, but in society in general. And I think gold will continue to be in demand and will continue to shine. And all of this, from a starting point of $2,000, basically. So the idea that Sunday was some kind of all-time high that we won't see again for years, I don't think holds any water.
Yeah, I agree. I mean, in the short term, they can knock the paper price down, but I think the fundamentals are very different with the demand for gold outside the United States. So non-G7 central banks, also private sector demand in a lot of countries like emerging markets. I think the Indian gold imports for their private sector, not their central bank. The private sector imports in India were up 95% year over year recently. For silver, they were up 120% year over year. So there are a lot of demand, bullish demand drivers, I would say, for physical gold and silver outside the United States. The other part of this, I would say, is that there's clear bull markets for the gold price in non-US dollars. So like Japanese yen, Chinese yuan, Australian dollar, these gold prices are at or near all-time highs. It's really just the dollar gold price that's, I say, range bound.
Has yet to break out. That's exactly right. And the last time we saw this was back in 2018 and 19. Everybody was going, how come, why is gold going to move to new highs? You got it in yen, and you got it in euro, and you got it in pounds. And you go down the list, and it was like, well, remember those fiat are always just compared to each other. It'll be the dollar gold's time soon enough. And sure as heck, that's what happened in 2020. So that's a very valid point. I think that's certainly something that we have to look forward to. And the yen gold has just been remarkable this year and how much it's gone up. It'll be dollar gold's time to shine. We're making new all-time highs right now, but it'll be dollar gold's time to shine and really surge before too long too.
And I want to give a shout out to my friend George Gammon over on the Rebel Capitalist YouTube channel. He just put out an excellent gold video today, and he showed a lot of the correlations, how the gold price in US dollars has not tracked CPI. It has not tracked inflation rate, the Fed balance sheet, the dollar, real inflation, real interest rate. And Craig and I were discussing this before we started recording. There's a reason for this, and Craig has been tracking all the stories as well as me, and so is the Gold Antitrust Action Committee. We even have Paul Volcker. He admitted this in his memoirs, and Alan Greenspan even said this in congressional testimony. Since the 1990s, there's been, in the U.S. government, the Treasury, the Fed, a clear objective to break all of those correlations. So anything that would rationally say these things, the Fed balance sheet goes to, 15 trillion. The gold price has to go to these levels. The CPI says that inflation's 9%. The gold price has to at least increase by 9%. There's been an intentional effort for decades, Craig, to break these correlations.
Sure. And it's all part of this movement since really the London gold pool failed in 1968 to manage the price. It doesn't mean it can't go up. Obviously, it has gone up. It's gone up tremendously. Just this century, it's gone from $250 to over $2,000. So it does go up, but it's a management of it that the banks are involved in. And by extension, the Bank of International Settlements and the other central banks and everybody else. And that's why, again, drawing back to Sunday, that's why you get the events like this. If the banks get really wrong-footed, again, I'll remind you, every single short owned by a bank or a hedge fund or the biz or whatever was underwater at the close on Friday. So something had to be done. They couldn't let it just get away to the upside. And that's why you get an action like you had on Sunday into Monday to paint the charts, kill momentum temporarily, and give them time to regroup.
Yeah, and on the supply side, the reason, well, why did they let the paper price go up to 1,000 or 1,500? I hear this all the time. Well, if they cap the price at 1,000 or lower, there would be shortages. There wouldn't be any metal available. There is no more gold to mine at $250 or 500. There's very little left at 600 to 1,000. I mean, we're talking about cost increases across the board for some of these mining companies for diesel and electricity and labor. I mean, the costs are just skyrocketing the last 3 years.
Anybody that says that has never taken a basic Econ 101 course. I had to learn that back in the late 80s when we studied like rent control in New York City. If you hold the price low, below the market, you have shortages, period. That's how it works. And so, again, you have to allow the price to rise to try to keep some kind of equilibrium. So when we ran out of physical gold to maintain price at a certain level back in 1968, what was basically perfected was a form of alchemy. And you got not first futures, after that, options, ETFs, unallocated accounts, all these different forms of leverage and hypothecation in the gold market to create the appearance of that there's more liquidity than there really is. Just to own this. This is just as good as gold. It's like even that Barron's article I mentioned earlier. They didn't say to buy gold. They said to buy the mining shares.
Oh, not GLD?
No, they said you should buy Newmont, which again, that's a whole other story. You could make a case that it's a value play. And I do think the mining shares are really going to have a good first of the year because, again, with their product now over $2,000, but with energy prices coming down this quarter, their next quarterly earnings reports are going to be pretty attractive versus the previous quarter versus last year. And so I would imagine Newmont, AEM, and the rest are probably going to have a pretty nice January into February. But I digress. The alchemy of all this is convincing the world that there's all this other stuff that's just as good as gold. It gives you exposure to price, right? And so in doing so, they've created this illusion of liquidity that there's more gold than there is. At the end of the day, there still has to be physical delivery that is made at however you derive the price, whether it's trading futures contracts or baseball cards. Banks in London have to flow physical metal into that market at that price. Otherwise, it's just fantasy. It's just make-believe. It's not attached to anything.
Well,
and that's why
aren't we also seeing the central banks? So like Poland and Germany, some of these other central banks, they're demanding that they actually have the delivery of the tonnage this time.
Sure. And again, that's cutting into the available supply. Have you ever spoken with Ronan Manley, Jason?
I'm speaking with him in emails. He's in Singapore, so he's, I think, 13-hour time difference. It's really difficult to get him booked for interviews. I've been speaking with him for months since you told me to talk to him to try to get him on for an interview.
I think I've never even spoken with him, but I think you would really have a fun conversation with him. And he's done great work, just connecting the dots, investigative work. And, the LBMA will sit there and say they've got 7,000 metric tons or whatever the hell it is. But when you look about what is actually unencumbered, what is actually maybe has clear title, which is what's actually deliverable, it's not even 700 metric tons because the LBMA counts the Queen's gold, Bank of England's gold, the gold that's in all the ETFs, it's custodianed in those vaults. There's 700 tons. Well, hell, total central bank demand this year is 700 tons. So, they've got a real problem on their hands. And that, again, is why you have to let price rather. There's actually some benefit to having a higher price to kind of cut into maybe some of the retail demand or the Eastern demand, because the Chinese and the Indians like to buy cheap, not so much expensive. Either way, the banks are on defense, but they had just briefly lost control and had to act with some of their just same old tricks they've always used. And that's what you saw Sunday. But that doesn't mean that we're not going higher. It just means that it might take a couple of weeks to kind of wrest control away from them as they get ready for the next move up.
Now, I know you do a lot of charting. You've been doing this for over a decade, and a lot of your articles have been on Zero Hedge. Do you think that the charts for like some of the gold stock indexes like OAU, GDXJ, they seem to me like I rarely see a perfect inverse head and shoulders chart pattern, and it looks like they formed a perfect inverse head and shoulders chart pattern for a potential breakout.
Oh, brother, if you like looking at charts, and anybody can, if we're all just kind of amateur TA guys, that chart of the GDX is fascinating. Just this year, one of the two most classic bottoms or tops that you can find is like a double bottom or a head and shoulder, a reverse head and shoulder bottom, or a double top or a head and shoulder top. Those are the classics that anybody can spot. The GDX has both of those bottoms. And they both came at the end with a little island reversal where you gap down for a couple of days and then gap back up. And that's another thing that's always extremely bullish or bearish, depending on which direction you're going. In February, came down to a perfect double bottom with an island reversal on the second bottom. In early March, up we went from 27 to 36. Most recently, now we have this easily spotted inverse or reverse head and shoulder. And on that right shoulder, you got another little 2-day island reversal and now a breakout above 30. Now the chart, again, it's what's hard sometimes is you look at these points on charts and you look at the data and you look at the monetary policy and the central bank demand and all this stuff, and you kind of find yourself working in this virtuous circle where it's like everything just looks like it's connecting, and you kind of got to stop yourself and go, wait a second, maybe I'm seeing things. But in this case, things really are connected in a way that it looks like we should have a pretty good 2024. Now, again, it's maybe not going, up 100-fold or whatever Bitcoin has done over the last 10 years, but it should be enough that precious metals investors and stackers should at least feel pretty good about the trend.
Well, the other thing is on the supply side, even though we have relatively high metals prices, the mining shares, the junior miners, they're in a bear market. A lot of it's because of interest rates and cost of capital. And then you have other people like institutional investors that are either anti-mining and pro-ESG, or people that are looking at, well, why do I need to go fund a risky miner or a shale oil driller when I can go get around 5% quote unquote risk-free with a 30-day US Treasury paper or money market fund? So that's taking away capital from the sector. That's going to cause supply shortages. There's going to be very few new mines coming online in the next 5 to 7 years with cost of capital and interest rates this high. It's a bear market despite metals prices being this high for bringing a new mine online and for juniors.
No doubt about that. And those of us that have been in the juniors and the exploration companies for any length of time, we feel every bear claw. I can tell you that. But I'll add, another functional problem with the gold market and price discovery and everything else is the way the Canadians run their markets and allow just bald-faced, naked short selling of the exploration companies. These hedge funds, they know what they're doing. They know that these those exploration companies they just inhale cash. They just burn through it like crazy. And so those predatory hedge funds, they use that, I guess, if you want to call it, to their advantage. And they short it, and they'll short these companies, and that'll force the company to, when they go to have to raise more capital, they got to dilute their share base even more because the price is maybe $1 instead of $2. A lot of times these hedge funds up there will actually massively short an exploration company and then get in line to be a part of that next dilutive private placement, and then use the shares that they get from the distribution of the private placement to then cover their short. Talk about there's easy money for you right there. But the Canadians allow this, and it's been utterly decimated.
They were allowing
the Canadian mining industry.
There was other shenanigans too on the junior mining side. They were wasting tons of funds on parties and first class plane tickets and hotels. They were also paying. This was the capital's not available now, but on Seeking Alpha, there was junior miners paying like article writers that weren't disclosing it over $500 or thousands of dollars for pump and dump articles. And then there was hedge funds on the other side that were paying Seeking Alpha article writers for hit pieces, to short stocks. Mm-hmm. And none of this was being disclosed. At one point, there was article writers that were taking money from both sides for different companies. But there's I don't think there's money for this anymore. But over the last 10 or 15 years, there was in the mining sector for a lot of these Canadian miners, there was a lot of Seeking Alpha article writers covering golden stocks that were taking cash payments from one or both sides for pump and dump or for hit pieces for shorts.
Well, and to your point, Jason, it leaves the mining industry not necessarily in shambles. There are some good companies out there that have great potential resources, and they continue to work and they raise cash and they drill out. But it's for where we are with precious metal demand, and in particular silver, given all of this, green stuff and electrification of vehicles and everything else, we're what we need for gold and silver and copper just to meet the physical demand in the years ahead. I mean, there's just not an inventory of proven resources that's out there, and it's all because of this, the accumulation of all this shenanigans over the years.
Well, also it's the banks and all these institutional investors. They have these ESG laws, so they're anti-mining. They're anti-regular. We're seeing this with uranium now. We're seeing this with oil and gas. So these institutional investors, these pension funds, even the banks, they have ESG policies in place now. The last 10 to 15 years in their bylaws, they either won't loan funds to resource companies or miners. So especially the non-ESG energy companies.
So again, you think about this just from a fundamental standpoint. Yeah, I mentioned the word value earlier when comparing like a Newmont as a value stock versus the growth of, one of the Magnificent Seven or whatever. There should be in everybody's portfolio some recognition of value, just like we talk about, stocks versus fixed income, which hasn't worked very well for the last couple of years, but traditionally always has. There's also should be some blend of growth versus value. So there's one component of the market is in favor, maybe the other isn't, and they kind of zing and zang and yin and yang and everything else. There should be, I think, investors, anybody, high net worth or family offices or hedge funds or whatever, should look at the precious metals and really the industrial metals too, and see the fundamentally strong picture and see it in terms of value, see it in terms of unappreciated future growth, which is sometimes what value is. So there's a place for this in a lot of people's portfolios, but yet what's the global ownership of gold and the gold miners? Not even 1%?
It's probably even less than that with the
it's
price
even less than that.
It's probably even less because these institutions are like, a lot of them are selling commodities. I mean, they're looking at like tech stocks as a value play. They're dumping energy. A lot of them are still against oil stocks. Now, you talked about correlations and inverse correlations. Have you noticed the last 12 or so months, kind of gold and oil have been taking turns? So it seems they're inversely correlated. So when one of them's doing well, the other one's kind of in a trading range or going down. Have you noticed that?
I have noticed that. Let me ask you a question back to you before I answer that. Did you see the article last week about how these these CTAs now are dominating them as much as 60 to 70% of the daily trading volume in the NYMEX and the crude oil futures? Did you see that?
What do you mean you mean just like day traders or?
Yeah. High frequency trading of these funds. They now
I mean, we're at 0-day options now. So,
right.
And those are like the algorithms, from what my buddy, Aaron, who does This Week in Charts for my YouTube channel. I mean, he was saying that like the institutional investors, the algorithms trade these 0-day options now. So it's absolutely bonkers. So
in that, with that kind of market, are we really discovering? Is there really price discovery? That's kind of what I'm getting at. So we can sit there and look at that, how this correlation isn't working anymore. Maybe this is, you mentioned George Gammon talking about this today. Maybe that's at the heart of all of it. Why these correlations don't seem to work anymore. Or why is gold going up and crude oil is going down or whatever, is maybe because the markets are now so distorted by these HFT and the algorithms and like every other form of derivative that's out there.
Those are just since the day trading algorithm started they started getting crazy around 2000, the technology around 2008. But I mean, like George Gammon showed in the video that the correlations broke in the 90s. So the 90s are when Larry Summers, when he was at Treasury Secretary, when he started putting out that paper, right, that the U.S. should start leasing and swapping out gold for interest rates and protecting the dollar, right, to make sure that the inflation rate looks much lower than it really is.
And again, so it gets back to it, again. Are the markets then actually efficient, and are they actually discovering price of an actual asset? Or are you just simply trading derivatives of that asset and using that as some form of price discovery? And that seems to be where we are. It's really curious what's happened in crude oil, even with the pickup and resumption, I guess, if you will, of hostilities again in Israel, Gaza this week. Crude oil is doing nothing. And it's about 15% lower than it was when all of this started 2 months ago. That seems counterintuitive, doesn't it? This threat of region-wide war.
So the hedge funds, the global macro guys are like deflation, recession, supply glut, supply glut, demand collapsing. Those are the narratives going around. I just had the top oil hedge fund manager in the United States on, and we went through the supply demand fundamentals. And there's no enormous global supply glut. World oil inventories at multi-decade lows. The U.S. has a slight supply glut, but the U.S. is exporting a lot of it. So I just like the supply demand fundamentals that hedge fund managers are shorting. And I mean, I think the Saudis are going to keep cutting. Honestly, I think they're going to keep cutting production because in inflation adjusted terms, they can't afford with their budgets. They can't afford $50 oil. I mean, they need much higher oil. The costs to produce oil are going up. They need to fund their government budgets. A lot of these oil countries, they can't afford $50 oil.
And in that conversation, Jason, did it come up at all about how much oil out of the Strategic Petroleum Reserve the U.S. dumped in the last year and a half? Did that come up with that guy?
Oh, well, we're down over 50%. So I mean, like, if you talk with the supposed oil experts that are always bearish oil, like Art Berman and some of the others, he was yelling at me on Twitter that the Strategic Petroleum oil sales stopped in November 2022 before the election, and that they were not dumping any more oil.
Okay. Well, either way, I know they want to try to refill it. And Biden has made a promise to refill it under 80 or 60 or whatever he's shooting for. Maybe again, my hat's on too tight, but I certainly wouldn't put it past the trading desk of the Federal Reserve Bank of New York to be fiddling around with the crude oil market to try to keep it down.
I don't think the environmentalists that are surrounding Biden, like the ESG people and the environmental lawyers, will allow Biden to refill it. So they kind of want to destroy demand, and they want people to buy electric vehicles. So I don't think he will be refilling it. I think the problem, Craig, in my opinion, will be to whoever's in the White House next.
Good point. That'll be theirs to solve. But again, we get back to, I guess, the overriding theme of our call, Jason, has just been these markets. Are they actually efficient in discovering price for the underlying issue or not? And I would suggest in most cases they're not. At least that's how they seem to me after years of watching them. And as it relates to gold and silver, the bullion banks have long been charged with managing the physical supply in London into the derivative price that's mainly based in New York. That's why, like, this Michael Nowak guy from JP Morgan, who's now in federal prison for manipulating price, he was not only JP Morgan's head of precious metals trading, he was also on the board of the LBMA, the London Bullion Marketing Association. So there's a hand in glove there thing. And when they get sideways, when they get in a jam, it doesn't mean price can't go up. I mean, I keep reiterating that. I mean, price is at an all-time high and it's up 8 or 9-fold this century, but it's a managed thing. You have to manage the flow of metal to that price. And there are periods when that management becomes challenging, and you get things like we got Sunday and Monday.
Well, James Turk has called it of Gold Money has called it a managed retreat. So they do not want to cap the price at a price where there is severe shortages, but they also don't want the miners minting tons of money on a consistent basis. So they kind of keep it in I guess an acceptable range to where like the miners can still produce some supply and the price is managed so it doesn't look like the dollar is collapsing too quickly.
Correct. Yep, that's exactly right. They just is kind of a coordinated dance. It's frustrating for all of us that are in gold and silver because we feel like they're vastly undervalued versus, the actual physical supply. But for now, it just kind of is what it is. I would just, I'd be happy with just a nice 20% gain next year. And I'm sure most people would too.
Well, I think all these markets are increasingly managed or manipulated. Look at the yields on the 10-year US Treasury bond in the last couple of months. I mean, they got up to around 5%, and then they're down now, I think, to 4.3%. And we were talking before we started recording, I don't think this is free market in the bond market. I think Janet Yellen and the voting Fed governors were there doing a lot of shenanigans off balance sheet because they decided that refinancing the $8 trillion plus of Treasury debt at over 1.5 trillion in the budget deficits is going to be a mess. So they decided they want to bring yields down. And
brother, what is ZERP and NERP and QE if it's not bond market manipulation at its core? That's all it is. And they've been doing that now for 15 years.
Well, the stock market too. I think we're at a point, Craig, where the stock market can't stay low for more than a couple quarters because then the tax receipts for federal government for capital gains tax collapse. If home prices collapse, I mean the property taxes at the state and local level, those would collapse. So, I mean, I think like the government has become over the last couple of decades increasingly more reliant on tax revenues from stocks and real estate.
Absolutely. I'm with you on that, my friend. And back to the bond market, whether there's already kind of a shadow yield curve control that's being done as it appears, that will not be so shadowy in the years ahead. There will, with the exploding amount of debt and deficit, the interest cost on just simply servicing the debt, there is no way the plates can keep spinning if the rates go to 6-8%. Just not going to happen. So there will be, it might be a shadow yield curve control right now. There will be an actual overt, obvious yield curve control plan that's coming. Of that, you can be certain, and that'll be the manipulation of the largest financial market in the world right there.
Well, I agree. The math doesn't work because you do not have the largest trade surpluses with the foreign exchange reserve. So your China, Germany, Japan, they are not net buyers of Treasury. I think China said they're going to be selling more Treasuries. I think Japan said they're going to be selling more Treasuries. So they are not net buyers. The non-G7 that used to buy a lot of Treasuries when the dollar was weak and they recycled Treasuries with trade surpluses, they're not buying Treasuries. A lot of them are buying gold tonnage now.
Dude, I just saw. Again, I'm kind of a little fuzzy in the head because I was out all weekend long. Went up to watch the Chiefs play the Packers, but I think it was Thursday, the month ended, and so maybe it was on Friday. It was either for November or for October, but the net Treasury issuance was something like $2.3 trillion with the refunding and that has to come due, and you got to raise some cash to pay those people off, and then you issue some new stuff, and you got all the new debt that's coming out. It's $2.3 trillion either in November or October, and rates have been coming down with all of this. These foreign central banks you're talking about cutting back on their demand, so somebody's buying this stuff. Maybe it's coming out of the reverse repo balance. Maybe that's what those dollars are quarantined for, but that's going to run out too.
And so is the Treasury General account. Yeah, the Treasury General account was flush when Biden took over office. That's drained. There's not a lot of, so the Fed may have to create another shadow liquidity program, but that's probably to buy all the toxic garbage commercial real estate. Because from what I'm hearing, none of the commercial real estate developers and none of the banks that are holding all these office buildings. I just heard an interview with a commercial real estate developer a long time when he said none of the banks and commercial real estate developers are marking any of the losses mark to market yet.
Right. Put that on your calendar for 2024 too. So again, kind of back to where we started. Sunday and Monday, if you're in gold and silver, was maybe eye-opening if you've never seen it before, but it was not something that signaled some kind of long-term top. That's for sure.
Yeah, I think they could just keep it in a trading range at this point, but there's not going to be new supply. And the demand, especially outside the United States, the demand by central banks, private sector demand in a lot of countries outside the United States, the demand is very strong. Now, demand here in the United States, people are buying Bitcoin again. People are buying short-term U.S. treasuries. So people are buying other things. They're not buying gold, but at some point they may diversify into gold, and that will create even more demand.
I agree with you completely, my friend. There are so many things working in our favor that, again, it can be counterintuitive too. We've certainly seen that before. But as we move into 2024, which is going to be a tumultuous year for our politics, the global economy, geopolitics, monetary policy, to have gold already at this moment above $2,000, you can certainly see a path to 23, 24, 2,500, and that would be beneficial to a lot of mining shares too.
And it wouldn't even be keeping pace with the official government consumer price index, because it was supposed to be at 2,300 with the CPI a number of years ago, and that was before all the currency debasement in the last 3 years. So the gold price CPI adjusted, we should be well over 2,500 already.
And that would work as well. Absolutely.